Can you see the matrix for what it truly is?
Today is a video on the dollar index and what I'm looking for Friday's delivery. So without further ado, we're going to get started. But first, let's start with a word of prayer. Our Father, which art in heaven, hallowed be thy name. Thy kingdom come, thy will be done, on earth as it is in heaven. Give us this day our daily bread, and forgive us our debts as we forgive our debtors. Lead us not into temptation, but deliver us from evil. For thine is the kingdom, the power, and the glory. Lord, we just want to pray that you'll be able to bless this lesson as I show what you have shown me. Pray, God, that you'll give me clarity, wisdom, confidence, and understanding to be able to dictate everything that I need to dictate in a clear and understanding form. We love you and thank you for giving us our daily bread. It's in Jesus' name that we ask all these things. Amen. All right, guys. So what we're going to do is we're going to take a look at this divine algorithm, and we're going to break down the dollar index using time, price, and then once we have gone over the arrays, then I will give my predictions really quick. So we're going to do something really quick. I promised y'all that we would go over time in the last video. So I'm going to give you guys a dive into this time right quick. So the concept is that time, a complete cycle, is ran every 9 years. 10 is the reset. So you'll be looking at, say, 1999 to 2009, right? And then 2010 will be the reset, and then it starts all the way over again to 2019. All right, so let's just put some vertical lines on the chart and we'll take a look at that. So let's look at January 1st, 1999. January 1st. What's that? December 08. January 1st, 2009. And January 1st, 2019. Right? So as we can see, this is our cycle, right? So let's give an idea and a concept on this really quickly. Let's go into it. So if we look back, even here, we could go to 89, right? January 2nd, 89, right? So let's get an understanding of some things. So if we can see here, we are bearish in this market. This was our overall swing. So if we were to take a high and a low of this market, we would get an equilibrium. Right, so let's post that, and it is 118.556. Hold on, guys. Hold on. Sorry. Had to get my cat up out of here because she gonna make noise and all that. I'm trying to make this video. Okay, so 556, 118, 556. That is our equilibrium. So let's set that as our equilibrium. Right? So there's our equilibrium of the entire bearish range. Now, what we see is this was our ending range here. So let's display that. Right? So there's your high. There's your low. Now, when we start this idea here at where we started, right, we can see that coming into this year or that year, and let's mark, we'll mark 1990 afterwards. Okay, let's see here. There we go, 1990. Okay. So coming into that year, you can see how we had this range already set up, right? There's your high, there's your low, right? So we are inside of a range until we break here, right? Do you see that? Now, from 1989, when we go 3 years forward, that will be to 1992. That would indicate the end of a cycle, or I'm sorry, 1990. It would be 1993. January of 1993 would be the end of the cycle, right? So once this know that the 9 ends it, the 10 continues, or it resets the cycle. So in between 9 and 10, there will be a range, right? We established the range here in the middle of 87. Look, we established this range. We traded into it all of 88, 89. That's your 10-year candle. You see that? And the reason why I'm telling you this is there are 3 cycles. You have 5-year, 10-year, and 30-year, right? Where do we get those from? The T-bonds. If you go to the bonds chart, you will see that the cycles that they come in. What we're doing is breaking down the 10-year cycle, because that's the cycle that we really need to look into, is the 10-year cycle. But we don't break it down by 5 years, because what happens is that the cycle moves in threes. So it's broken up into 3 phases of 3, because there are 3 phases in the market: accumulation, manipulation, and distribution. Here we start out with our accumulation. You see, we end with a range, a high and a low. We come into January of 89 right here. We create a high and we create a low. Well, you can look at this as a high and a low right here, right? So essentially all we did was create what? The wick of this 10-year cycle. There's your high, right? Then there's your low. Well, that starts the range. Just what starts the year, right? You can see how it starts. Now, after we pass January 1990, what do? We have this accumulation. Here's the manipulation, the beginning of the manipulation. Look how it takes out. When we first come, what does this tell us? Right here. This is your change, or this is what we would classify as your change in character. This will be your selling climax, right? So there was liquidity above in the range. There's always liquidity above and below a range. So when we started out, we took the liquidity here. Then we came here, traded inside of this range. Then here we had the continuation model, right? You had the institutional order flow entry drill, or the continuation model. to begin what? The 3-year cycle of the manipulation. The manipulation comes in at, it begins 1990. It will end in 1993. The January of 1993. Right? So as we see this, this is our accumulation, manipulation. Look how we come back up, take that range, we pull back into what our range that was created here. See that order block, range, there's your swing high, down candle, there is your order block that it came right back up into, right? See that order block, up candle before the down move comes right back up into it. What does it do? Proceeds to take out this low, right? They have to come back. These are early buyers. This is where they started buying. So they started buying here, got them some orders in the market, come back, offset their longs with some shorts, get them a better price, right? They get the better price down at the 78,250 number, right? So they get them a better price right before the what? The distribution cycle starts. So look, we had the accumulation cycle, the manipulation cycle. Then here in 93, we start the distribution cycle. What lets us know that we started the distribution cycle? You see this short-term high? Look at this. This here is your stop run, right? Over here, stop run, right? You see the stop runs. So if we go to this cycle, we see a stop run. Now here, once we break this short-term high, this becomes our market structure shift. Now remember, this is fractal. We have a market structure shift because we had an accumulation. We had a take of the stops high. We push low, came back in the range, push lower again, take the stops here. So we took the stops above this high. We took the stops below this low. There's your reset. That is the reset before we begin what? The distribution cycle, right? So we break that short-term high right here. See that? Swing high, short-term high, takes the low, we push above it. What comes after the short-term high? I told you guys last time what comes after the short-term high, after the break of the short-term high. Optimal trade entry. Always there will be an optimal trade entry. Now, you can use the bodies on this. So you go from this body low to this body's high. Right there. Right now, look at that. Right into it. Bink, 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 bink. Right into 79% retracement level. Respects this 83.5. What do we have? An order block. And we come into the kissing candles down in here where this is a balanced price range because price traded up, pulled all the way back, open and traded back up. So this, in essence, from this high to this high is a balanced price range inside of our order block, right? So we can get a good entry here, and it gives us that entry all the way down into the 89%, or even this range here, this 83.5. The bodies respect that. And we begin our distribution cycle. See that? Start the distribution cycle. Now, the continuation of the distribution cycle happens where? It starts to happen in 1996. So this is your distribution. This begins the distribution 1. It comes back down, distributes price down into here. Now we get our bullish intent, right? This is your what I call the payout cycle. So now the official payout cycle has started here, right? Once we break both of these highs, this is your payout. Well, it'll give you a continuation. So what we are doing is we're looking here, right? This starts it. There we go. We have the There's our order block right there. Optimal trade entry. Again, we push above short-term high, right? Created a swing low, right? Swing low. We break above this. This is our break in market structure right here. Above here is your break in market structure. This is your shift. This is the break in market structure here. It's your break of structure right there. You get a break of structure. After you get this here, where this pushes out, this is your 2022 model. You get the swing low, market structure shift right here with the engulfing, takes this out. This now becomes an order block here. Once that high is traded through right here, traded through, this becomes a bullish order block. It trades back down into what? The 4 value gap, 2022 model, right? That's your 2022 model or institutional order flow entry drill right there. Trades back down into it, right? Then proceeds to push through it. Now what do we come above? This order block. What do? We accumulate here. Look how we accumulate price. You can see right here, out of this candle, all the bodies stay. You see? The bodies are staying within that candle right there. Right there. We get this to tap into it. What does this become once this is traded through here? Order block, right? You get your order block, trades back down, taps the order block one more time. And then what do? Proceed to our distribution, right? This is your second distribution cycle. So you can look at this as you have an accumulation, manipulation 1, manipulation 2, distribution. Now we have this distribution cycle, right? Now it starts over again. It starts over as, so they talk about the AMDX. In reality, this is really all one complete cycle from 96 all the way to 99, right? Well, 93 to 99, it gives us a whole complete distribution cycle where it comes back down to get its price, right? Distributes, it had a mark up, a mark down, and then it proceeds for the payout cycle. Now, this is where we want to be getting in. It's in the payout cycle. This moves here. Now, we do the exact same thing. What do? We create a high, we create a low, right? Create a high, create a low, right? Now that low, where does it go to? It goes right to what? The continuation. Or this would be, if you're looking at this on the higher time frame, do you guys, if you know what model it is, say what model it is. You'll know what model this is if you trade it. But if we were trading this on a lower time frame, this would be your silver bullet model, right? It's already going where it's going to go. It had a break of structure. It pulls back into what? A 4 value gap right in here, and then proceeds for the continuation. Silver bullet is a continuation model, right? That's what you have to understand. What models are for? This is your first risk entry model, or you can use the order block. This is another continuation model, right? The 4 value gap, the 2022 is a first pricing continuation model. Silver bullet is a already break of structure continuation model, right? There will be kind of a silver bullet here. Now, what do we see as we move through what? January 1st of 1999. We see the same idea, the same context, right? Look at that. Same context. Breaks to the high. Gives us an idea where it's going to go. What does it do? It pulls back. Pulls back into what? Oh man, that's another one of those for value gaps, ain't it? A continuation trade, right? continuation trade. Gave us the high, pulled back, gave us a continuation trade. Now from here to 2003, what are we looking for? A manipulation phase. So we can go all the way to January 2003 and get a manipulation phase, right? So it continues to the upside, delivers to what? Our equilibrium. Look how it draws right into that equilibrium price point. 1, 2, 3, get your failure swing, right? You get the failure swing, creates a high, and a high, then gives you a failure swing, and then breaks the structure. Why is this a break of structure here? Right? What makes this a break of structure? Well, if you've been following my channel for some time, I tell you guys the difference between a break of structure, and that is 3 lows taken at once. Look at that. 1, 2, 3. See how those 3 lows are taken at once? That is a dramatic price run. That is a hard push to the downside. That's your break of structure right there. After the break of structure, we accumulate in this price level. We create this M pattern and we accumulate right into what? That area right there, that breaker. See that breaker? We didn't come up into this. What is this right here? This is the breaker because it was swing high, swing low, swing high. That makes this a breaker, right? What is this candle here? We had a swing high, a swing low, and a lower low, right? In the form of this is your market structure shift, right? Market structure shift. When you get a market structure shift, this is a mitigation block, right? That's your mitigation block. But when you get the break of structure, it's not going to come back up to this mitigation block. It's going to come back up into what? This breaker for value gap. Breaker proceeds to accumulate, proceeds for a first stage distribution for a what? Low resistance liquidity run. You see these lows down here? We have all these lows that it needs to come get. There is stops under all of this, right? We built up, we built up, we built up. We got to our price point. That was your mark up phase. This is your mark down phase, right? Same thing in your market maker sell, market maker buy, right? Original consolidation, reaccumulation, reaccumulation. You get the reaccumulation, smart money reversal, right? Break of structure, first stage of distribution. You get your redistribution, stop run through the original consolidation. You see that? We hit right here. That's your redistro. Then pulls down for the stops down below, right? You see how we take those stops down below. Then what does it do? What time does it do that in? Right before what? Our market reset. Look how you get the low resistance liquidity run, right? The distribution phase, right? Right after here, right after the 3rd year, what do you get? The distribution phase. Then what? 2006, what does it give you? A continuation model, right? Look at that. Continuation model right up into what? Order block. Swing high, swing low, swing high, mitigation block. Right here at the low, mitigation block. See that mitigation block? Order block. There you go. Check it out. Mitigation block and an order block combo. Continuation model. It gives you an idea of internal liquidity at a swing high, right? Right down into, right? A correction, right? You get this break of the short-term high or short-term low right here. So if you were to take from here to here, what happens? Because this is your market structure shift, break of the short-term high, optimal trade entry, right? Optimal trade entry. My mic is creeping up. It's creeping up on me. That's funny. My mic was creeping up. Here. To that body to body. Look at that. 62% retracement level. Order block. Look at that. Right down to that 0.5 standard deviation. See that? Right through that 0.5 standard deviation. Right? Gives us our level to project. Right? So it gives you an idea of where price is going. Right? And that happens all on our second stage of distribution, or the continuation, or the AM, or you have the A, the M, the D, the X, right? The X is the continuation, right? Or you can look at accumulation, manipulation, distribution 1, distribution 2, right? Then you get a reset. What happens here? 09, look at this. Pulls right back up into what? This liquidity. Look at those two equal highs right there. Creates a low resistance liquidity run, right? Because you get a market maker buy model, market maker sell model right here, right? Then you get the continuation to the downside, right? Accumulates, leaves you stops right there inside of what? A for value gap. So it's going to be a magnet. Once it pulls out of what? This whole number. Yeah, there it is. Let's see, 71. That whole number of 71 is what it came into. It's going to come into the 80 below that, right? So you see that. As soon as we get that run up. Take those stops, right? What is that? That is your break, or that's your market structure shift. Short-term high, right? Takes the short-term high. There's your market structure shift. This is your reset also. At 9, what does it do? Creates a high, creates a low, right? Go to 2010. Look how it gives you that low, right? Inside of this range here still, right? What does it come down into? For value gap, right? You see that for value gap that it comes down into? There it goes. Starts the manipulation phase, runs back up, runs back down, takes those stops into what? This order block. You see that order block? Propulsion candle right there also, right? Look at that. Right into the order block. You just mark this candle opening. That's the order block, right? When do we start the next phase? 2013. Look at that. You see that? Accumulation, high and a low. Runs down. Starts the manipulation phase where it runs back up. They think it's going to buy. Why? Because we bought off of this other level. Buy, early buyers, right? You get back into this. This is a harmonic pattern also. Bottom. So you get that right there. Pulls back up right here. Look at this. Another market structure shift. Short-term high. Breaks that short-term high. Right? Now, what are we looking for? Swing low before the market structure shift. Right? After we get this, we get that swing low after that market structure shift. To the high, this should be an optimal trade entry. Right? You're going to take the wick though. The difference is, the reason why you're taking the wick here is because this is a wick and these are wicks. So the best entry price is going to be on a wick, using the wicks. Right? I want you guys to understand that. There are times when you use the wick on the optimal trade entry, and there's times when you use the body. The bodies is here. Say, take for instance, see this right here? This was your market structure shift. There was an optimal trade entry. There were two optimal trade entries. There was a first optimal trade entry, right? You see that? 79%. Bing, goes to the zero up here to gather what? Internal liquidity here. Then it has more internal liquidity that it engineered here, right? Engineered the internal liquidity here. So it has to come back and take that also. That was your next optimal trade entry. You could have kept it at that same high because we didn't break that high. Bing, comes right back, 93.5. Look how the bodies respect the 93.5, 50% of this order block. And then it proceeds to move up. Give us a what? Another market structure shift right here. Now, this whole down range becomes an order block right here. What do? We accumulate. You see how we inside this candle, this one single candle. Let's move this fib so you guys can see that. Look how we accumulate right inside this one single candle. Bing. We accumulate all inside that one single candle. Again, that was our swing low, break of a short-term high, optimal trade entry, wick to the wick. Look how the bodies respect that 79% retracement level. Then what do? We proceed to give the payout cycle. Right? You see that payout cycle happen right in here. And that's going to go up until what? The next 3 years, 2016. Sorry, guys, for that background noise. That's my wife. She's sleeping right now. Her alarm's going off. So look at this. 79% retracement level gives you 2 standard deviations within that range, right? Then what does it do? Proceeds to come back down into this range here. You see how it gives you the up thrust, smart money reversal, back down into what? For value gap. Look at right here. For value gap. Where is that for value gap? Should be right at about 50% of this range. Look at that, 50%. Right? Look at 50% of that range right there. Right? From here to here for value gap. 50% of this range. Right? You can, right there. Bing, look at that. Right in there, right? Then what do? We continue. If we go on a lower time frame, once we go on a lower time frame, what we'll see is that there's an order block inside of here. Let me lock this up. My son has been playing with it. There's an order block inside of this area here, this balanced price range, where price traded up, traded back down to the middle of this, and then proceeded up through that to create that imbalance, right? Notice how price did not trade back down into here. It shot up. This is truly an imbalance. Then we have a balanced price range. Rocks down into that balanced price range, right? And then proceeds to move away, right? For the continuation. Now, where are we at? We're at the reset again, right? Are we at the reset? This was 2019. Why do you guys think COVID happened? What had to happen? A manipulation, right? Look at that. Ain't it crazy how you would know that off the charts? What? What do you mean? What? They did the same thing. Look how it accumulates right here. Get a high. You get a low. Stops above there. Stops above here. Stops below here. Right? It's out of this range. Break of a short-term high. Right? Break of a short-term high. We have the same for value gap that we were talking about. Look how it trades back right into that exact same for value gap. right? What's in these bodies? Stops. There's volume in there. What are they coming to get? All that volume. Did they take this stop down here? No, but they took this one for sure. What is this? Order block, right? You see how we have this wick down and this very hard high wick up? That's when you take your wicks again. Wicks to your wick. It gives you an optimal trade entry. Once more. What's the key? It came back down into the for value gap, created liquidity here, and there's liquidity resting above here. Took the internal, came back in here, created internal, took this internal back down into here, and this internal right there, right? Look at that. 0.5 standard deviations. This is where we are now. So if we're in 2020, we were in 2020 for the manipulation phase. Look at that. Buy up, come back down. We manipulated up here. Well, where do we start the cycle? 2023. Look at that. Manipulation, run up hard. Look at that, run up hard. It should take it to stops, right? For value gap, right? Look how we take that balanced price range up, back down, back up. This from here to here is a balanced price range, right? We run through that whole thing, one candle, all the way down through. Right there, shift that structure right there. And we've just been accumulating here. Look at how we're at the beginning of a phase. What are we at the beginning of? A low resistance liquidity run. Did y'all hear that? Now we're where we're at. 2023. We just finished 2023. We've come into 2024. What cycle are we in? We're in a distribution cycle. Where's the liquidity? It's inside of this range. Swing low. Look at these equal lows here. What's here for value gap? What's down in here? Bullish engulfing. What's this? Order block. You see that? Order block right there on the monthly. What's here? Equal lows. Where are we at? Up here in this for value gap. Look at this monthly for value gap. Right? Look at that. Trade up into it. We trade up into it. Look at this area here. What we're going to do is we're going to also mark this area of this area right here is your area of balanced price range. We can mark 50% of that. Wait, from there to there. Yes. Okay. Low to that high. I would go to the high of this candle. I don't want to go to the high of that candle. I like the high of this candle because in reality, this is what this candle right here is what's called an outside bar. What is an outside bar? An outside bar takes the stops of a low and then takes the highs. And then look at this. Let's see here. Let me take that away. Look how this out. So let's explain something. This is where you start to understand candlestick patterns and where they come in. Again, like I was telling you guys, candlestick patterns, harmonics, Elliott wave, Wyckoff, it all plays in the same structure, right? It's just understanding Wyckoff is a mark up, reversal, mark down. Then you have an extreme mark up in price or a hard run up, right? All this is Elliott wave still, right? You have 1, 2. It's still your second phase. This was a flat running. This is your 3, right? There's your 3 phases. 0, 1, 2, 3, 4, or 4, because this is the low. 5. There's your 5 wave, right? Let's look at that, right? Let's go from here. Let's go from here. Or truly, let's start from here, because this was the reversal. So we'll start from here. 0, 1, comes back into here. 2, 3, 4, 5. Look at that. 5 wave. Look at that. Oh my goodness. Did the Elliott wave work? Oh my goodness. It's an Elliott wave, and it worked. But why did it work? It's the context around it, where it's being built. You're understanding, like ICT talks about, the imbalances are the true structure in the market, right? This was a Gartley pattern here, a hard Gartley at the bottom to give us an Elliott 3-wave drive to the high. Now what are we in? A low resistance liquidity run back down into this area, right? We've taken internal liquidity, created internal liquidity, internal liquidity, internal liquidity. So now we have to come back, run the internal liquidity, and what do we proceed for? External and external. There's your 5 wave, corrective model, move back up. This was an entire move, right? You could look from here to here. Look how it comes into your 38%, 38, 50%. Oh my goodness. Look at that. Ain't that what Elliott wave comes into? 38 to 52%, right? On your first wave, 38 to 52% of your first wave. There it is right there. 38, 50%, right? We're within our golden zone. We're about to have a correction, right? Man, this stuff works. Oh my goodness, it works. Look at this Wyckoff model, right? You got a buying climax. You got an automatic rally. You take that stop. Take that stop. That's your manipulation. Sign of strength. Comes back down. Spring. Gives you a second sign of strength after it takes that high. Test. LPS. Move up. It all works. It's all the same. It's all part of this whole algorithm. You guys just see parts of it and use the part that you like, that you see the easiest, right? But it's all the same. Look at this here. From here to here to here to here. Gartley pattern, right? There's a Gartley pattern. I don't think that we're going to drop back down into this, but we could. There could be a low resistance liquidity run all the way back down into that area. All the way back down into this original consolidation. Is this the original consolidation? Right? Remember that. This is the original consolidation. So we could move up, and run all the way back down into here. Imagine us distributing all the way back down into there. We distribute here, pull back up, and continue after 2026. That could be that catastrophic failure that we was talking about, right? Events happening in the world. How do they do it? This is what they plan the events around, right? Just want you guys to know that we're in the distribution phase, right? Low resistance liquidity run, knowing where you are in the market, understanding the time cycles. Gartley usually means a hard fall off, That's what Gartleys imply. Gartleys are usually hard falls. But then again, it could be 2 here for this continuation on up to the upside. So we'll just have to see what happens when we get here and how it moves back up into this area, right? Because remember, there are stops below all of this, all inside of this imbalance range. So we could correct, pull back, and correct lower. Never know. And this could be the formation of a shark pattern, right? This your low original consolidation. You come out of a consolidation impulse. So we're going to measure it from here to here. That's our impulsive range. This starts the corrective range. An A, a B, a C, and a D leg could be down here. So look, you start from your A to your B, or I'm sorry, yes, A, X to A. I'm sorry, X to A. 38%. That's all we need. 38.2% to 62% is what we're looking for the sharp pattern. Well, we come here 38%. From the low to the high, we come to 38%. Let's switch to some other fibs. We'll switch to the harmonic fibs, right? So when we come here, we're looking for this to be 113 or the negative 172 in between this. Up to here, it can hit this and pull back. I don't like to see it go all the way up here and then pull back. That would not be my idea, but it can. Don't think that it can't go all the way up here to this one extreme of this 116 and then pull all the way back down into this range. That's an extreme shark. But here we have this up into this 113 area, 382, right? Look at this consolidation that they engineered right in here. Convenient. Right after this run, right? There's stops below. Look, stops below these lows right here. Relative equal lows. Stops below that. Right? So we could be looking at something back down into this 886 level. All the way down to this 73, 74 whole number. Down at that 73.50. Right? So we could be looking at something like this over the next cycle. Right? There's your shark pattern over the next cycle. Right? Look at that. And then what we proceed to do? Distribute up. If this is to the 786, this could pull back here, and we could actually have a hard run up after that. Right? You can see that above the 786, even to the 886. Comes back, and then we would be looking at a deep crab running all the way up here to this 167. What's up there? Look at that liquidity. See that? Right? This would be a deep crab from here to here. Now remember, this is all on the monthly time frame here. So it's going to take a lot of time, years. Look at this, all the way up, deep crab. Way in 35 somewhere. You see that? Deep crab. Well, what do we have here? From this down to there, 50%. Now we're back down into our 113 level. See that? 50%. Original impulse down. Corrective range A, B, C, D level, right? All the way up above that. That's your shark pattern. There's your 113, 181, right? So there's a possibility of it coming all the way up there. Even with this 1618, it could come up to the 1935, right? If this matches up with here, look at that 1718, 113, 1835. This is a fib cluster right here. These are in close proximity. We could be looking to come up into something like this, right? And the overall pattern would be this shark pattern. That's happening here, right? So there's no guarantees on these patterns, but I see them. And I understand what type of range we're in. We're in a corrective range. But what part of this range are we in? Again, we're in a distributive cycle. So I'm not just going off the harmonics. I'm looking at them because there are patterns inside of patterns, right? inside of patterns. This Gartley pattern could give you an idea that, look, we're in a range. You see, from here to here, we're trading in a range. Harmonic patterns are best found inside of a range. This was your, now I'm about to really give y'all some sauce. Here it is. There was your stop run. Accumulation, manipulation, distribution. This is your distribution cycle. Starting right here, major distribution cycle. That's your 30-year cycle. See that? That's your 30-year cycle right there. You got a 30-year cycle. Accumulation, manipulation to the upside, to the equilibrium. Down low, down here into a premium pricing. Pulls in, takes the internal liquidity. Internal liquidity, yeah, internal, external, right? So that's what we have to look at, how this thing can run, right? This is your distributive cycle begun, low resistance liquidity run. Test this area. Then begins your continuation cycle, your big continuation cycle, right? If we were to look at a 12-month time frame, this is a yearly cycles. Look at this. What do we have? Do we have a for value gap down in there? It's hard to see because of the candles, but there's your original consolidation. See it down in there, consolidation. Your break to the upside. Look at that yearly order block that we hit. Bing, hit that yearly order block. Respected the 50% of it. Look at that, 50% order block. Down candle, moved away, right? Corrective range, low resistance liquidity run. Back down into what? This area here. Right through that candle. Look at that. There's stops right under these bodies right here. See those bodies right there? Stops. Maybe even under these bodies. Stops. But I would be looking for under these bodies right in here. Then you can find you an order block. Let's mark that right here. Make that a golden line. Look at that. Right? Then we could drop back down into our monthly. That was your 12-month. Single months. Look at this. There was your bodies. Look at that down candle right there. You see that hold down candle right there? Hold down candle. Now what's interesting is right here, there's an imbalance. See how this pushed through this right here? And here there's wick. That's a type of volume imbalance. That is a volume imbalance. Right in there. Order block. This here is your order block. That's your lowest down before that move up, right? This was a volume imbalance. Price will magnetize to what? That volume imbalance. And we can have a corrective range, right? Another thing we can understand is if we were to take our fibs and go from here to here, our projection should be 2618 of that range here. We go here. How do we do projections? We go to style, we go down, and we reverse. This is a projection. Look at that, 2618, right? 2618 of that, right into it. Real crazy, right? I know. Now look here, look how that 1727 is what? Support. See that? 1272 support for this, for value gap form there. At what? 50% of this range. Well, what is this? This is a running flat right here. Right out of that, right? Again, understanding these ranges and what happens, this is how you can predict overall major prices, major time swings, right? I'm giving you guys the time algorithm. Again, it moves in 3 years. Every 9 years, 1 to 9. 10 is always a reset number. Remember that. 10 is a reset number. Two numbers together. After you get to two numbers together, it's a reset number, right? So you're looking at the reset numbers to 10. We had that back in 2020. Reset gave us a manipulation. Now we're up here to the final phase where we took the highs, ran those highs quickly. Look how I pushed to that to the quick side. Now we're here, right? Now it's time to go into this area and see what we're doing. We're in this. Let's go to the weekly, right? Now that we've understood that we had this, let's look here, right? Wait. Let's go back to our monthly right quick, because this is going to make sense once I show you guys this. All right, let's go back to that balanced price range right there, right? Let me spread this out. I promise you guys this is going to make sense. It's going to make a lot of sense. All right. Remember, from this low, this candle's low, because it took that to that candle's high. This was a stop run, so that's irrelevant. I want this candle's high because we shouldn't pierce that high, right? That is the balanced price range. Let's go down into the weekly. Now, as we drop into this weekly, we see that we had the same idea, right? We had the same idea as we had in 2015 with the accumulative range, right? We made it as we come into this time, we made a high and a low. See how we made this high? We made a low, right? This is your restart of this cycle. Low, right? So we have a high. Well, even here, let's do this, because let's do the one before. There's your high. There's your low, right? Or before we ended the year, there's your low, right? There's your high. There's your low. So let's do it before we ended the year. Better yet, there's your high, swing low. Then we come into the cycle and immediately push down. What does that let us know? That we're going bearish. This is your bearish push. What happened here? Market structure shift. See right there? Push through that low and pulls back in this. That gives you a market structure shift. Then we created a short-term swing low, right? Short-term swing low. It created relative equal lows right here. Engineered liquidity for us to run, right? Now, what did we talk about? We created a swing low, a swing high, ran stops on a short-term swing lows. See this? Short-term swing low, ran it. What happens after that? Optimal trade entry. Now, with this one, I will use the wicks. There's a reason why I'm using the wicks, because when both of these candles have wicks like this and they're equal like that, and this one also has a high wick like that, you're looking to use the wicks, right? Now, when we do use the wicks, look at that. 83.5. Look how those bodies respect that 83.5, right? 83 wick hits the 89, but doesn't quite come into our 93, right? Beautiful. Distributes off, right? We get that first stage of distribution. What do we have right here? Swing low. What is this, right? Let's look at this, right? This is your optimal trade entry. Remember that optimal trade entry. Now, what's right here? Remember, this was our monthly for value gap. Monthly for value gap, right? That was our monthly for value gap. There's your consequent encroachment. Now, why did it not hit that consequent encroachment? Well, do you remember this little balanced price range area over here, right? You remember we had that outside bar right here, and then this price move back down, right? This is from up here, these two candles. That was the monthly order block, but that's not what we're looking at. We want to look inside this balanced price range. What occurred over there? This candle right here. According to ICT's core content, what is that candle? Think about it before you think about it. Think about it. Did you say it? Or are you just waiting on me to say it? I might let you do your research on it. It's a reclamation block. What happens in a reclamation block? They go up. This is their first selling point. This is when they start to cover shorts. This is a short covering right here. Last down candle before this up move, right? You see that? Hard up thrust right there. You get all of that, right? This in truly turns into a breaker, right? A breaker right in here. Or you can use both of these down candles because in reality, both of these are a single candle, right? So you could use that as a breaker, but more importantly, this is what you look for, that reclamation block. It's beautiful. Now, over here, aside from that reclamation block, we have a reclamation block, and what do we have right here? Is that an IFVG? Yes, it is. It's an IFVG, right? We have an inversion fair value gap right at that reclamation block. Look how it hits this stop run hits the consequent encroachment of it. And look what it does right here. Look at that swing low right there. What is that? When it breaks that swing low with this hard thrust down after, look, it hits stop run, hits the consequent encroachment, has a what? What is this? Market structure shift. We talked about those, didn't we? Market structure shift. Inside of a monthly FVG, inside of a weekly inversion fair value gap. Right here, we get this hard thrust, this engulfing candle out of this consolidated area, right? Because in reality, price was consolidated inside of this one candle here, right? It ran the stops on that consolidation right there. See this candle? This is the consolidation candle, right? I want you guys to see that. We're going to mark that candle right there. Let's see, we're going to mark that with, let's mark it with the purple. There, you can't see that. You can't see that. Let's see. That deep purple. Let's do it at 3, right? Let's see that. Notice how the bodies, every one of these bodies were inside of that candle. That's a consolidation. I want you guys to look at new ways to understand consolidations. Those are all inside bars. Not necessarily, because in reality the wicks went out, so we wouldn't count it as an inside bar. But what I'm looking at as an inside bar is because the bodies stayed inside. The bodies respected this price point. That means that everything they were gathering orders up, they run up, they working the high. Now look how all the bodies respect this inversion fair value gap. Then we get this hard thrust right here. Let's delete these because you guys understand that that was the consolidation candle. So we're going to delete these. This right here, what was that? What is that? Do you remember what that is? That's your market structure shift. Hard thrust, market structure shift. What happens after a market structure shift? You get this up candle. What does it tap back into? That monthly fair value gap. This up candle right here. Order block. Look at that. See that up candle right there? That's your order block. Taps that one too. Look. Order block. But this one is your highest run. You got an order block, propulsion candle. See that right there? This is your propulsion candle. Or I'm sorry. Yes. No. Because this ended up being a down candle. But nevertheless, this is an order block. I would use this as the order block because it's a stop run. Up in that, on a lower time frame, I believe there's a low order block in there. Once we go down to the daily, we should see an order block up in there. Maybe even up in this candle's range or this candle's range, right? But I'm looking at that candle, that hanging man. See that hanging man? That's the reversal candle. bink. That's what they talk about, hanging man. Now these candlesticks are proficient on the higher time frame. On the lower time frame, it's just creating something. Now, what we're looking at here is right here to right there. You see that? That is a weekly for value gap. That is what price is being drawn to right now. We came down. We did not clear these stops. You see how we did not clear the stops in that range? What do? We filled this for value gap right here. We got these stops below those bodies and engineered liquidity inside of these ranges. This is what price is searching for up into here. This was your market structure shift, hard push away. That let us know that we are now bearish. This is now a bearish move right here, right? Now we're coming in 2024 where we're about to go into the distribution cycle. 2023 gave us the end of the cycle, which is this high to this low. We are now about to push back up in that range. This is your up candle before the down move. Let's just mark that up candle. That's our weekly order block, right? Let's do that. Weekly OB, right? Now let's drop down into a daily. Now, as we drop down into the daily, we can see the for value gap in the daily, right? There's a bigger for value gap in the daily to run up into. So that gives us even greater idea of where we should be running. Right there to right there. There's your buy side liquidity, right? Daily order block. There's our up candle. All three of these are an order block, but there's a reason why I'm choosing this candle. See that how it made that swing low right there? That swing low, that's important. Very important. It made that swing low right there, right? That's your daily order block right there. You got a weekly and a daily. This was the weekly right here. This is your daily order block right there, because this weekly is all of these, but that daily is that one right there. You see that? And we got this little gap. We should not fill this little gap. That's your breakaway gap right there. That we should not come up into that price level, right? Now, as we look at our daily, what are we looking at? This was our, you see how we had that market structure shift right there? Boom, boom. Optimal trade entry from here to here. Optimal trade entry. See that? After the market structure shift, there's always an optimal trade entry. Optimal trade entry. Right there, see? Up in a for value gap. Right? Boop, boop. Look how they respect that 79% retracement level right there. All the bodies respect it. And then move away with that hard thrust. Right? Now, we talked about this being your order block. You see those up candles right there? There it is right there. This is, all of these are order blocks. That right there. All of that up candle, that's your order block. This here is a breaker, but we don't touch that breaker. What we touch is this here, this candle, this swing low. You see this, we had this swing low, swing high, swing low into this what market structure shift. What do we talk about this candle being? That's your mitigation block, right? You see how we come into 50% where this for value gap is, right? We hit that for value gap, mitigation block, order block right here that we talked about, and then we proceed to move away with a hard bearish move. There's your imbalance. Creates liquidity here, equal highs up into this daily for value gap, right? So we got a weekly, a daily, weekly order block, daily order block. Now, what are we forming? Swing high, swing low. Break of that short-term low right here. Break of that low. This is your optimal trade entry. Look at how the weekly rests right on that 79% and our daily rests right on that 89%. So check this out. This is also a harmonic pattern. We're looking at a shark pattern, a bearish shark, right? This is your VWs, your W's to the downside. Now let's look at this high here to that low there. See that? 50%. There's your 114 right there. Hit the 114. Pulls back into this range. Where's that 886? Right there at the high, that for value cap. This is what I'm looking for. I'm looking for price to pull down here, here, and I would like to see price hit the top of that for value gap. Now, what's up there? Right above that, we have this small area in price that I want to see price hit right there. That is your volume imbalance. I would like to see price come all the way back up into that volume imbalance. And let's take this down to a 1 so it can be seen a lot better and not close together. There is your volume imbalance. I would be putting my order right there at that volume imbalance. Until then, I'm bullish on this price level. I'm bullish. We've had our second stage of accumulation right here. This was our 2022 model. See right there? Same thing happened. We come at that back down into this for value gap. We're on an impulsive move up to a D point, to a termination point. We're looking at ending price about that 105,660. I like that. What's the high or the opening of this candle is? Let's do it right there so we can see opening this candle. The opening is 105,647. At 105,650 sounds perfect, but I will put my order at that 105,647. We'll probably hit this, move down. These are going to be your manipulative ranges, right? When you come up into these ranges, you'll probably go here, down, here, down, then trade up, down, market structure shifts. This is your breaker structure right here. Come back into what? Mitigation block, low resistance liquidity run. All right, you have a low resistance liquidity run right through that low. Back up, then you have another low resistance liquidity run. All the way down through there, right? We can see price move just like that all the way down through these lows. Low resistance. This is going to be a low resistance liquidity run after we come up into price like that, right? This is what I'm looking for on dollar. So tomorrow or today, as we come in, we're in an accumulated range. We've already came down into that range, right? Look at our 7-hour time frame. Why do I use a 7-hour time frame? We'll talk about that later, but that is your price cycles moving 7-hour time frames. But look how we have this here, right? And we're getting ready for this move up, right? I would like to see us come back down into this for value gap today. Right here. Take that internal liquidity there, right? Back into what? This order block. See that? Order block. And then we should push up. Hold down candle before this up move breaks that. even look, breaks that area there, right through there. That's your bullish intent. Right here is your order block, right? It's your 7-hour OB, 7-hour for value gap. Go down into your 4-hour. See that? Order block right here. Down candles. This is your, look at that, IFVG right there, right? 1 hour. Once we drop down into that, we can drop down to our 1 hour. Look at that. Stop run, bullish intent, right? What do we break? Short-term high. Come into a for value gap right here. We should be pushing down into this, getting ready for a move up. So that's what I would like to see, down into this balanced price range right here, and maybe no lower than this area here. I don't want to see it go lower than these candles here. Those are 4-hour order block right there, right there. Bing, bing, bing. And we should move up here. We should keep going after this. We'll come back later on with the results to this, but you can see high and a low. We've already ran the external liquidity, and you got your support here at this order block. Bullish intent. This is now your order block. Down candle. We should respect that down candle. What are we seeking? Stops above here at Tuesday's high. They engineered the liquidity to run this range, and I would like to see us run straight up into that weekly for value gap. I'm looking for us to run straight up into that weekly for value gap, and then we're going to trade into it. That begins our descent up. But today, I want to see it run up into that. So that's what I'm looking for. I gave you guys time. I gave you price. I showed you how things work. We'll just keep going over this. The cycle repeats every day, all the time, and it never stops. It's the same cycle all the time. These cycles repeat. Year after year, day after day, they all repeat. Remember, we're in a distributive cycle. We're at the beginning of 2024. About March, you should see us trade up into this weekly for value gap. We're at the end of the month here. February and March should be your smart money reversal months. And then we're going to come into March where it trades to the high, gives you a market structure shift. And in April, when the true year opens, then we'll have our distributive phase. Okay? So until then, I'm bullish on dollar. Waiting on this smart money reversal. It's going to be beautiful. I hope you guys are ready. Remember, you heard it here on this channel first. I told you guys, the Lord has blessed me with this knowledge, and I thank Him for it. So, we'll be making money soon. Until I talk to y'all again, may the Lord bless your trading.